Okay, it may look like the market was relatively flat, but there was action. We're here to talk about it with Larry Shover, SFG Alternatives Chief Investment Officer, who's here to tell us what he thinks the Fed will announce tomorrow and how the markets will react. And Scott Shellady is in the pits of the CME. Okay, Scott, yes, it just looks like the market was flat to slightly lower, no real direction, a lot of jumping up and down across the flat line. But where did you see any kind of sentiment that indicates what might happen tomorrow?
Well, that's the best question out there right now, Liz. You know what? I think what's going to happen is we're not going to get a taper announcement tomorrow. But what I think should happen is I think that with all the Feds talk about forward guidance, they should give us some forward guidance on a taper. How about this? Let's taper July 1st as long as we keep seeing the numbers go our way. If they start to go south, we reserve the right to push the taper off. I think, having spoken to a lot of guys in the pit and in the market, that the best thing the Fed could do tomorrow was give us some guidance about the taper. The market right now clearly is in a little bit of a defensive mode. They don't know what to expect tomorrow, but I still say we're not going to hear anything. It's going to be same old until maybe January.
Scott Shellady, that's one of the best ideas I've heard yet to give forward guidance on tapering. It has become a part of the portfolio of the Fed. Larry, what do you think is the best thing that could happen for the markets tomorrow?
I think the best thing that could happen is for the Fed to say, hey, we're going to taper, not today, but we're going to taper in January because the numbers justify that fact. I don't think it's good for the market if they don't taper. I mean, Bernanke might pull a September and say we're not going to do it and have an initial rally, but I think it's going to be bad for the market. I can't agree with Brother Scott at the CME right now.
Scott, he's throwing down the gauntlet here. What do you think?
Well, I tell you what, if they're truly data dependent and a 7% unemployment rate, which is low because of a bad participation rate, and we've got no inflation, we've had two decent jobs numbers, and all of a sudden the world's okay again? How about this? 48 million people still are taking food stamps, and that 7% unemployment rate still not coming down fast enough. I say that the economy has still got some major hurdles. I don't think we want to take our foot off the gas just quite yet.
Larry, you have no doubt. You've talked about those hurdles before. Now, we do have a pickup in growth, particularly world growth. You see kind of the whole world getting its act together a little better, and that's going to affect investment plans, right?
Oh, absolutely. And starting with the U.S., I mean, I think 2014 GDP, 2.3, 2.5%. I mean, let's face it, the residential market, it has leveled off a little bit, but we've found a floor, not a ceiling. We have ways to go. Business confidence will come back. Reduced fiscal drag from state and local governments. All these things are pointing to a recovery, not including Europe. I mean, Europe is just in a formation stage of coming back together. So I think tapering is just a status quo for tomorrow.
Well, here's some breaking news from KKR. This is, of course, the private equity fund in the buyout office. This operation is now closing what had started as a real estate fund because, of course, they've made so many deals. They've done extraordinarily well. The news is that this is the first real estate fund for KKR, and they've made about 12 investments. Wow. They're closing it at about $1.5 billion, so it's obviously done well. They had the firm's employees investing nearly $300 million in this new real estate fund. So what does that say, Scott? It says that maybe there is some real salubrious effects of what's happened over the past several years, that real estate, commercial and otherwise, finally stabilizing, and that we're returning to perhaps, yes, the old new normal, but at least it's normaler. More normal. More normal.
I'll take it from there. How about this? We've seen the slowest recovery that we've ever seen coming out of anything like we've ever had before, number one. Number two, I've sat through some of those investment portfolios where folks are trying to get you to plow your money together and buy a bunch of houses. Yeah. Guess what? The reason why housing markets have gone up is because there's nothing for sale. They bought them all. Yes. Wait till you start seeing these KKRs unloading all the stuff that they bought. That's going to continue to depress the West and Southwest. I say the housing market still has a long way to go. And if you want to brag about the housing markets finding a bottom, good luck, because we've got a mountain in front of us.
Well, here's another thing that's going on, Larry. You do have a change in the financial structure of this country. Banks don't do what they used to do. Of course, the government is more in mortgages and the banking in terms of the housing market, more into it than most banks are right now. 9 out of 10 mortgages come from Fannie and Freddie. So there's a change. Nevertheless, despite all this change and rock and roll in the financial industry, you're recommending two financial stocks, J.P. Morgan and Wells Fargo. Why?
I just think we have a long way to go. And again, we have found a floor, not a ceiling. And let's keep in mind, Wells Fargo is going to produce stable returns, maybe not superior returns. Let's also keep in mind that Wells Fargo is deriving their P&L from 89 different identical revenue streams. It's not just mortgages. Mortgages are a big part, but not the only part. JP Morgan, it's regulatory, legal, trading problems. Every day we read the newspaper, there's some kind of problem with JP Morgan. I think that's fully baked into the stock. And keep in mind, they're starting to expand much more into wealth management, credit card fees. The revenue to fee structure has changed dramatically since 2009. So I think they're positioned, as our economy continues to grow and continues to grow out of this deep dive we've taken, that they will do very, very well in the future.
Well, you also like Owens Corning. Give us a line about why you love this name right now.
Well, I love stocks that are on sale, and I think Owens Corning is a stock that's on sale. I mean, let's face it, we've had a cyclical recovery, one that's fragmented and broken, and like what I really truly believe is that our building recovery will continue to persist in 2014, 2015. They have good cash flow. The revenue stream is good. Their debt to equity is pretty good. With that in mind, they're a recipient of that good building recovery that we're going to see in North America.
Scott Shellady, you and Larry are kind of the yin and yang of the CME. When we get notes from Larry every morning at 9 a.m., they're like 3 pages long. Your notes are about 3 lines, and one of those lines from your notes is 10-year truth serum. What do you mean by that?
I tell you what, if Larry was right and we were doing that well, we would go back to that 3.5%, 4% level that we had before we had all these problems. I think the 10-year is telling us we still have a lot of problems ahead. Now, there's actually been some stuff that's been put out lately that says don't get too crazy about that 10-year yield rising. We could see 2% at the end of 2014. But let's boil it down to the simple truth here. This is what it is. Number one, we have one camp that thinks that the fundamentals in the economy justify the equity prices where they are today, and the other camp that says, hey, we are 180% higher in equity prices than we were in the lows of 2008. Do you think the economy's 180% better? Absolutely not. Those two camps are going to fight it out. The Fed's in the middle. 2014 is going to be the story. We'll see who wins.
Larry, who's an optimist out there? I certainly am. Fox Business certainly is. Our viewers who are traditional business investors love to believe that America's fought back, they're coming back, and whether you believe that what the Fed has been doing is sort of smoke and mirrors, okay, fine, but you cannot deny that businesses have been created. We had Warby Parker. They said, yeah, 2 years ago we decided to start our eyeglass business. They've been doing extremely well. They've been growing. You can't count out that the spirit of American business is still alive and well.
Yeah, and I agree with that. I mean, I am a big optimist right now. I mean, I think the fog is starting to clear. Scott is right. We do have a lot of hurdles to climb, but we've done a really good job at climbing some of these hurdles. With that in mind, business confidence has been lacking because of all the dysfunction we've seen in Washington and the fiscal drag on GDP. That is changing. I mean, I'm predicting a 2.3, 2.5 GDP. I'm very optimistic. We've fallen down a very, very long flight of steps, and we're climbing our way back, and we have a long way to go up.
Well, you guys look pretty good for a bad fall. Larry, thank you very much.